with China now centralizing its metal through the Shanghai Gold Exchange, and now we're told restricting silver exports, along with the U.S. classifying silver a critical mineral, and they too can restrict exports. What's happening in Shanghai as a direct challenge to the LBMA's role in global price discovery, and maybe even more so towards market dominance?
I guess it depends on the various axes of power. When we look at the BRICS nations and the countries that are friendly to the BRICS, it's more than half of the world's GDP now. We really rely on the London market in terms of price discovery of gold and silver. $100 move in the price of silver translates to a $200 billion liability. And that gets quite messy quite quickly on a bank balance sheet. So that would be the biggest concern. I can kind of see it in a lot of the commentary which is being written on the bullion banks is, we're relieved now that the price of silver has run higher and now we're going to see more silver come into the market and that's the end of the run.
Global precious metals dynamics are shifting rapidly, and analysts Andy Schectman and David Jensen warn that the changes unfolding in Asia may redefine how gold and silver are priced worldwide. They explain that China's growing control over physical metals, especially through the Shanghai Gold Exchange, is becoming a direct challenge to the LBMA's long-held dominance in global price discovery. At the same time, China is reportedly restricting silver exports, while the United States has now classified silver as a critical mineral, giving Washington authority to restrict exports as well. These developments signal a major geopolitical turning point. With BRICS-aligned nations accounting for more than half of global GDP, their collective influence is beginning to outweigh traditional Western bullion centers. Jensen notes that a true physical-driven silver price could severely strain bullion-bank balance sheets, since a $1 move in silver can balloon into massive paper liabilities. Despite some Western commentary claiming the rally is finished, Schectman and Jensen suggest the opposite. Structural shifts in supply, demand, and global power indicate that the real move in silver may only be beginning. If you found this helpful, like, share, and subscribe to the Metal Bar, turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
The LBMA is being structurally fragile. And you just mentioned that the market where the spot price is higher than the futures price, this is called backwardation, and something that we saw to an extreme level a few weeks ago.
Yeah.
And then, as you mentioned, the infusion of 50 million ounces, kind of a lifeline, took care of that. But here we see a slight increase in backwardation again. In your view, the backwardation, along with perhaps maybe you can discuss the unallocated positions and the overwhelming volume of paper, gold and silver versus physical.
On October 10th, the market seized up in London. And that is despite the fact that they had roughly 790 million ounces in the vaults in London. But of that 790 million ounces, approximately 650 were held by exchange traded funds, so should not be offered into the market. And the remainder, which was approximately 140 million ounces, was not offered to market. So what we got there, Andy, was on that day, we caught a glimpse of where the bottom of the barrel was. And the London market actually bounced into that bottom of the barrel. So even with 140 million ounces not held by the ETFs, there was no silver liquidity in London. So we know that market is tapped out circa 140 million ounces of non-ETF gold. So with the addition of, notionally with the addition of 54 million ounces to that market, they've got a little bit of liquidity. But I mean, even the LBMA now in their statistics state that they're trading on an active day, they're trading more than 700 million ounces of silver every day in the cash immediate delivery market, immediate ownership and immediate delivery market. So if you've got 50 million ounces, but you're trading 700 million ounces a day in these cash contracts, and that speaks of an open interest or total claims in the market of at least a couple billion ounces, you can see how weak this market is, and that the market has actually failed. It's just a matter of the London market has failed. It's a matter of it, silver purchasers recognizing this. And I think what we're seeing today with these 4+% price moves after the price had come off, 10, 15% here a couple of weeks ago, is that investors and purchasers are stepping in to acquire what little silver is left in that market. London right now operates on a silver in, silver out basis. If they get silver, they can deliver some silver. If they don't get any, they are unable to deliver silver. And we saw that from that signal. They've got a 50 million ounce buffer right now, but they are dependent on continual deliveries of silver to meet delivery demand from these cash contract holders.
Yeah, I cite your information regularly. And when we talk about the LBMA, they, for a good portion of the year, it's a T+1 exchange. T for the trade day, +1 to settle on the third day. Those bars should be moving.
Yep.
But as you know, it was 8 weeks because we were told the Bank of England had a shortage of manpower and trucks. And I cite your figures regularly in the respect that, you say there's roughly 2 billion ounces of deliverable contracts out there against a 140 million ounce float. What could possibly go wrong? Or trading 700 or 800 million ounces a day in deliverable contracts against a 140 million ounce float. What could go wrong? Or even Bruce, I forget his last name, Ikamoto. I'm sorry, yeah. Bruce. He talks about 3 million ounces of platinum traded every day with 0 platinum in the vaults. What could go wrong? My question to you, that I think is paramount to your analysis, is how confident are you in the LBMA's reported trading volumes and inventory figures?
But I mean, in 2013, the LBMA was indicating that they were trading about 2.5 billion ounces of silver a day in the cash market. 2.5 billion in a world where you're producing 800 million ounces a year. Now suddenly that number has dropped to around 700 million ounces a day. So we really don't know. It's an opaque market run by banks which have been charged with fraud on numerous occasions. So we really don't know. But the idea that the 140 million ounces is a float, I mean, that's the amount of silver not held by ETFs. But if you want to talk about a free float, what is available to London when you're at the 140 million ounce level right now, the free float is 0.
It's the 55 million ounces that they got injected in there.
Right after that. So we've got about 50, and we don't even know of that 50 million ounces, how much of that is held by private investors who are willing to deal that into the market. We do know the benchmark on October 10, there was 140 million ounces in the vaults not owned by ETFs, and that the free float on October 10 was roughly 0.
The global silver market is revealing deep structural cracks, and industry analysts Andy Schectman and David Jensen are sounding the alarm on what they believe is a historic breakdown at the LBMA. Recent market behavior shows growing backwardation, a condition where the spot price rises above the futures price, signaling extreme physical tightness. While a recent 50 million ounce infusion temporarily eased the pressure, signs of backwardation are returning, suggesting the underlying problem is far from resolved. Jensen explains that London's silver liquidity has nearly collapsed. Despite roughly 790 million ounces reported in LBMA vaults, about 650 million belong to ETFs and are not available for sale. That leaves around 140 million ounces. Yet even that supply was nowhere to be found on October 10th, when the London market effectively hit the bottom of the barrel. The system only regained temporary breathing room through an additional 50+ million ounces injected into the market. But this relief is overshadowed by the LBMA's own data showing daily trading of 700 million ounces in immediate delivery contracts. Against a remaining float of roughly 50 million ounces, the imbalance is staggering. Billions of paper claims now sit on top of a vanishing pool of physical metal, creating what Schectman and Jensen describe as a market that has already structurally failed, with the world only beginning to notice. As silver surges following recent pullbacks, investors appear to be stepping in to secure what little physical supply remains. Let's get into the interview.
The daily auction price that they set there, the daily silver price that they set in London is the one which I'd say 80 to 90% of mining contracts utilize to set the silver price that is recognized for the delivery of metal. So it is an absolutely crucial market for the world's gold and silver price discovery. It's a very different market from the COMEX, which is primarily a hedging platform. And I mean, you can get silver delivery in New York, but there are numerous rules written into the COMEX rule book which allow for forced cash settlement.
Right.
And the way that London is different is it's a private market in terms of each contract is different and is written between two parties, and there's no real exchange that can intervene into those contracts. The contracts are governed by the common law and contract law in the UK, and even the Prime Minister and the King are subject to that law, as we know from Magna Carta. So it is the most important global gold and silver market in London, and that's what draws my focus to it.
Right, and to your point, the COMEX, like they did to the Hunt brothers, can change the rules to suit the exchange, whereas in London, you are dealing with a peer-to-peer, over-the-counter, kind of like eBay, so to speak. It's one-on-one, and eBay doesn't come in and intermediate or be a judge or jury. It's a more true way of doing business, I guess, is how I look at it. But suffice it to say, is the COMEX and the LBMA two sides of the same system, or does one ultimately depend on the other for price control and stability? I guess would be my first question. A lot of people ask me that.
Yeah, well, I mean, when London's closed, you can materially move the price of gold and silver with the futures market in New York. It does influence the spot market, or has historically. It's becoming less important now that we've got true shortage in the market, and we see the spot price, the cash price for gold and silver, for silver, is above the futures price, the December's futures price still. This is even after an injection of 50 million plus ounces in the last month back into London after their available metal ran dry in that market. So, and that to me is the crucial thing. Is we had visibility in October of a market basically pausing or stopping into a forced stoppage because of lack of silver liquidity offered into the market. So New York is a hedging market. It's a futures market. London does offer forwards, but more than 90% of the trading there is in the cash or the spot market for immediate ownership and immediate delivery.
The deeper we look into the global precious metal system, the more it becomes clear why analysts like Andy Schectman and David Jensen believe a structural shift is underway. London's daily silver auction price still anchors 80–90% of global mining contracts, making it the single most influential hub for physical price discovery. But as liquidity tightens and spot prices rise above futures, even after another major silver injection, the stability of this core market is being questioned. Unlike COMEX, where forced cash settlement can override physical delivery, London operates as a true peer-to-peer marketplace governed by UK contract law. That system offers transparency, but it also exposes when supply simply isn't there. And recent market behavior suggests London came dangerously close to a complete stall, revealing how fragile the global silver structure has become. As futures markets attempt to influence price while physical shortages grow harder to hide, the disconnect between paper metal and real metal is becoming impossible to ignore. If London's physical foundation continues to erode, it may signal the beginning of a major repricing event across the entire precious metals complex. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.